So welcome to this channel. This channel will be dedicated towards giving educational videos, educating ourselves on some forex terminologies, what forex market really means and all of that. So welcome today. Today we're going to talk about how to read forex charts in 5 minutes. So reading forex charts, reading the chart is part of the foundational level every beginner needs to understand, and we'll go straight up to it. So how to read charts, very easy. Now let's move forward. One, we have what is actually a forex chart. A forex chart shows how a currency pairs price moves over time. Each bar or candle represents how the market moves during a specific time. So as you can see, the display here where we are having each one of those candles is basically talking about each candle represents the number of time is being formed. For instance, we have different time frame. We have 1 minute, 5 minutes, 30 minutes, 15 minutes, 1 hour, and the rest of them. So when you go to each time frame, every candle represents each time. Every candle represents that particular time frame that you are in, maybe 5 minutes, maybe 1 minute. So each candle you see there represents that particular period of time that time frame is. So that is forex chart. The charts that you see when you open your MT5 or your trading view, those things that you see, they are your chart in the market. They represent the money that's been spent, the transaction that's been spent. So for instance, now we have Euro USD. So when you check Euro USD or even dollar, that is XAU USD. So on a 1 hour chart means that each candle, every candle represents 1 hour of price. So it takes a whole 1 hour for each of those candles to form. I hope you understand. It takes each of those candles 1 hour to form. If you take it to 5 minutes, it takes each of those candles you will see there 5 minutes to form, and another one will be open. So forex chart shows you how currency pair moves over time, over that particular period of time, which is the time frame that you are using in forex. So it represents how the market moves during a specific time, which is the time frame that we are talking about. Now let's go to candlestick, which is the market language. Why is this the market language? Candlestick is the only thing that you will see on the chart, and that is actually what represents every transaction that is being made in the market. That is the meaning of the market language. That's the only thing that you will see. You will not see any other thing rather than the green and the red candle. Now every candle has the open, the close, the high, and the low. Here I don't know why this one was giving me this is wrong. So this open and this close that they are putting here represent this red. We'll take it for the red. For the green, actually the green open here at this place where I'm pointing the arrow, the green open below, because you buy from below and you sell from the top. So the green open here below, the green open here below and closes here above, while the red opens above here and closes here. The top here that you are seeing is called the wick or the shadow, so they call it the upper shadow. So this is the top, this is the highest point the price got to before we had the rejection, and here we have it as the lower shadow or the wick. So this is the lowest point the price got to before we had a rejection. Same here as well. This is the highest point the price got to before we had a rejection. This is the lowest point the price got to before we have the rejection. So every candle always have the open, the close, the high, and the low, which is what you're seeing here. The open price is the beginning of the candle, is the beginning price of the candle where the market opened from. And I've said for the green candle, which is a bullish candle, as you're seeing here, it opens from below. It is this red that opens from above here. So the green candle, a bullish candle, opens from below and closes at the top here, while the bearish candle opens from the top and closes from the below. That's what this thing is saying. So it's saying that each candlestick has 4 key parts, and they are the open part, the close, the high, and the low. That is where price started, where price ended, the highest point the price reached or got to, and the lowest point it dropped, where we started having the rejection. Now let's go to time frames and how long each candle covers. Time frame. Now, what is time frame? Time frame is basically the period of time that each candle is being formed, and we have different aspects of time frames. We have the 1 minute, we have the 3 minute, 5 minute, 1 hour, 15 minute, 30 minutes, 4 hours, daily, monthly, weekly, yearly, and so on and so forth. So now, time frame is how much each candle represents. Time frame is how much each candle represents, the time it takes each candle to be formed in whatever frame you have opened it, either the frame of 5 minutes or any other one. So for instance, here we have example like the 1 minute time frame, the 1 hour time frame, and the daily time frame. So if we check this example here, use this time frame. So for daily, it means that one of this candle is not all these candles. So you want to count all these candles, that means this candle takes 1 2 3 4 5 6 7 8. This alone, this that you're seeing here, takes 8 days for this candle, because each candle is formed in just a day, 24 hours. That's what you're seeing here. So this represents daily time frame. So one candle here represents 1 day, another candle represents another day, and this one represents 1 day. So each candle on daily time frame represents each day, one day. Now let's go to 4 hours here. So this one is showing one candle here represents 4 hours. So it takes 4 hours for a candle to be formed on this particular time frame. So if you check another one, it takes another 4 hours for this another candle to be formed, and another one will be open after 4 hours. So every 4 hours is when you will see new candle open here on this particular time frame. So the time frame is limited, the candle is limited to the time frame that we have opened. Now we have the 1 hour here as well. So 1 hour, one of this candle is 1 hour. So 1 hour, 1 hour, 1 hour. So it takes 60 minutes for each candle here to be formed. So if you go on and on and on like that to different time frame, all of these things are formed based on the time frame that you put it. If it is 5 minutes, it takes 5 minutes for each candle to be open. That's what that one means. Now, what did they say here? They said scalpers use lower time frames, swing traders use higher time frames. Now we have the three different types of traders. We have the scalpers, we have the day traders, and we have the swing. They are the most popular, right? Those three. So the scalpers use the lower time frame, which are like 1 minute, 5 minutes, 15 minutes, 30 minutes. We have the day traders that uses daily, 4 hours and 1 hour, and we have swing traders, those people who can hold their trade for a long period of time, 1 week, 1 month, 6 months, 1 year and above. So they uses daily, weekly, monthly and yearly like that. Now, currency pair structure. Currency pair structure. Every forex chart is a pair. Every forex chart is a pair. And what is the meaning of a pair? A pair is two things. So 2 things means that you're trading one currency against another. You're trading one currency against another. For instance, we have Euro USD here. This is a pair. Euro USD is a pair. You're trading this against this. Now, you're trading how one currency performs against another. You're trading how one currency performs against another. So if you buy Euro USD, that means you're expecting Euro to rise against USD. If you buy Euro USD, you expect Euro to rise against USD. And if you sell, you expect Euro to rise. You expect Euro to fall. If you sell, you expect Euro to sell. So this is how it is. Now, when you have a currency like this, You have euro, you have USD. Now, when you're expecting euro to rise, you will definitely use the dollar that you have to buy the euro, because after your analysis, or after your all of the expectation that you're doing, you are expecting euro to rise, and so you can buy more of euro. You buy more of euro because your projection is that euro is going to rise, and that's the reason why you are buying euro. That's the reason why you are buying euro, so that when you get to a point, you can sell and make profit. So when the thing is high, is on the bullish side, you are buying, you are saving, you are investing. And when the euro is falling, you are selling, so that you will not make loss. So you expect that euro is going to fall, you definitely need to sell. So if you have bought the euro at the rate of maybe 1,000, and the euro is moving up 1,500, 2,000, so you're making profit because you bought. Now if you're expecting it to fall, you need to be selling, so that what you bought from 1,000 will not be giving you 500. That's what that one means. Now let's move to price action basis. Price action basis. Now, price moves in trends or ranges, right? Price moves in trends. That's how it is. Price moves in trend. And we have three different types of these trends. We have the uptrend, we have the downtrend, and we have the sideways. Now the uptrend is what you see here. The uptrend is always with the higher high, higher low, higher high, higher low, higher high, higher low. And when this higher high is to be formed, there is a need for break of structure, which is here. There is a need for break of structure. There's a need for break of structure. So when you are seeing this breaking structure to the upside, you definitely know that the buyers are in control. The market is purely bullish, and the buyers are buying. When the market is breaking structure to the upside, such as this, and creating higher high, higher low, higher high, higher low, that's the uptrend direction of the market. The opposite of it is the downtrend. When the market started from here, rejected at this particular point, come back and broke this previous low that we had. Originally, there's a break of structure here, and this break of structure is going to the downside. So we are having break of structure to the downside, and the market went up to create another lower low, lower high, and broke another structure. So the market has changed character here from being bullish to being bearish. Now it is now breaking structure to the downside. Breaking structure to the downside here. So we are having the lower high, lower low, lower high, lower low, lower high, lower low, until the market is ready again to break, to change character, where it can now break this lower high. The moment it breaks this lower high, the character is beginning to change. So the third one here is where we have sideways. Sideways is also known as a ranging market or consolidating market. This is a place where we have equal highs and equal low. Example is this sideways market. So here the market bounced up from here and came back to this particular place, bounced again. So the market has been ranging, the market has been moving in between these particular lines, between this rectangle. So we are having up and down, we are having support and resistance here. This is the top of the rejection point, which is the resistance, and this is the bottom of the rejection, which is the support. So that is what sideways market always gives. There's no direction here, and that's why they will say stay away from ranging market, because it does not have direction. If you think market is going to get to this resistance zone and drop again after it has tested several times, after so much ranging in this box, it might not be true. It might not be true. The best traders are those that are patient, that wait to see the movement, the clear movement of the market before they can jump in for either the buy or the sell. And that's why you're expected to stay away. Now, in a ranging market, we have two types of ranging market. It can be on higher time frame, and ranging markets can be on lower time frame. When the ranging market is on a higher time frame, it's telling the swing traders to hold on And when the market is ranging on lower time frame, it's telling the day traders to hold on, probably like higher time frame ranging like daily, 1 month, 1 week, a ranging market. If the market is ranging on lower time frame such as 4 hours, 1 hour, it's telling the day traders to hold on while the scalpers can be moving. But if it is ranging on 5 minutes, 1 minute, everybody needs to hold on, right? So that's why you say you stay away from a ranging market, because there's no clear direction yet. Now, they said focus on structure, support, a good support, which is also called a key support, resistance, and also trend lines. That is what will make you to stay profitable in the market. Understanding structure is very important. What is the structural bias that the market is giving? Is it on a bullish side? Is it on a bearish side? Or is it in a ranging market? For you to know how to plot your key levels, for you to know how to plot your setup, that will actually give you, and you definitely know that you can't be trading against the market. You can't be trading opposite the market. So when the market is clearly bullish, your alignment is in bullish trend. So you want to put your setup as what the market is doing at that particular period of time. And when the market is bearish, which is a sell, you always want to be in alignment with the market, because that is what will give you the quick profit that you are looking for. I hope you understand. So if this actually educates you so far, like, comment, and subscribe. We're going to be having more of educational videos like this. Thank you so much. You can share with someone that will benefit from this.